In 2007, a company was bought, and the debt used to buy it did not land on the buyer. It landed on the company. About $2.4 billion of it, sitting on Claire's own balance sheet by the end of the following year. The year before the sale, that same balance sheet showed no long-term debt at all, not a dollar, 4 years running. The stores did not borrow that money, they never received it, and they never spent it. Let me be precise, because this sounds like it cannot be legal, and it is completely ordinary. Apollo Global Management put in $600 million of its own cash. The rest was borrowed, and the borrowing was backed by Claire's and repaid out of Claire's. Roughly $1 of the buyer's own money for every $4 borrowed against the company. Here is the household version. Imagine somebody buys a rental house, and instead of paying with their own money, the house takes out the mortgage. The tenants keep paying rent, but the rent does not go into the roof anymore. It goes to the bank. The house still works, it just cannot keep itself up. Two questions remain. Why was this company the one it happened to, and who ended up paying? To see why Claire's was worth buying, look at what had been built. In the mid-90s, Claire's ran 1,214 stores, and it owned none of them. Its own annual report says, the company leased all of its stores, generally on terms of 7 to 10 years. That is the whole engine. A shop of between 900 and 3,000 square feet inside an enclosed mall costs very little to open and needs no land. So you can open another one, and another. What went inside was cheap. Most sales fell between $5 and $10, and after the cost of the goods, the rent and the buying, about 54 cents of every sales dollar was still there. The thing that brought people in was already the piercing. That same filing puts pierced earrings and the fees for piercing ears inside the category that made up a majority of sales. Small room, cheap stock, fat markup, and a service that gives people a reason to come in and a date to come in on. By the start of 2007, that had multiplied into almost 3,000 stores. Look at what that machine produced in its last full year before the sale. About $1.5 billion of revenue, $189 million of net income. Revenue was up 8% that year and up 7% the year before that. 2 straight years of growth. $232 million of cash generated by operations. Actual cash in the door. And claiming that cash, nothing. No long-term debt. Steady money, growing, out of thousands of small identical rooms. Nothing already spoken for. No buildings to maintain. And because the shares traded on the New York Stock Exchange, the whole company had a price that anybody could pay. Read that list again. Every single item on it is a virtue. Predictable cash is good. Low debt is good. Not tying your money up in real estate is good. Being publicly traded is how the company raised the money to grow in the first place. That is not a coincidence. The same qualities that made Claire's a good business are exactly what made it an ideal thing to buy with borrowed money. Being publicly traded has a second edge. A public company is permanently for sale. Only the price is unsettled. The sequence is in the merger documents. On November 14, 2006, a hedge fund called Jana Partners publicly disclosed that it held almost 3 million shares. On the 1st of December, Claire's announced it was exploring strategic alternatives, which is the phrase a company uses when it may sell itself. Then a sale process, run with Goldman Sachs. The proxy, the document sent to shareholders explaining the deal, describes it as extensive, publicly known for months, and involving discussions with about 13 parties. The price was $33 a share in cash. The board's own document sets out what that was worth. 18% above the closing price the day before that hedge fund's stake became public, and 3.4% above the price the day before the company said it was looking at its options. The board recommended it unanimously, and shareholders voted yes. The proxy also told them exactly what they were giving up. They would cease to have any ownership interest in the company and would not participate in any future earnings or growth. On May 29, 2007, the merger completed and the shares stopped trading. Now the part that decides everything. The year before the sale, Claire's generated $232 million of cash from operations. The year after, it generated $6.8 million. That is not a rounding error. Same shops, same products, same customers, and almost all of the cash is gone. And you do not have to take my word for where it went, because the company's own annual report says so. Interest paid on the debt related to the acquisition, $123.6 million in 1 year. The year before, That same line was $118,000. Thousand, not million. Working capital, the cash cushion for day-to-day bills, fell from $343 million to $59 million. This is the arrangement for the next decade. The stores open in the morning, the customers come, the money comes in, and a large share of it leaves to service a debt the stores never took on. By 2018, Claire's filed for Chapter 11, a court process where a company keeps trading while a judge sorts out what it owes. The restructuring eliminated about $1.9 billion of debt. The creditors holding that debt, Elliott Management and Monarch Alternative Capital, ended up owning the company instead. The company came out of the restructuring with $575 million of fresh capital. The debt problem was solved, genuinely solved, and then the same shape came back. That repeat is coming, but first a question everybody skips. Was the retail actually any good? We can, because in 2021, Claire's tried to go public again and filed a registration statement, the paperwork for selling shares to the public, with the Securities and Exchange Commission. The offering never happened. The document is still there, and it is the most honest thing this company produced. In it, Claire's describes itself as the world's largest ear piercing service provider. Then, the numbers. Piercing was more than 20% of retail sales. The company was doing about 100,000 piercings a week. And here is the number that explains the whole business. Roughly 55% of the people who came in for a piercing bought jewelry or accessories that same visit. More than 60% joined the loyalty program. Piercing sales at stores open at least a year, so not counting new openings, had grown for 25 quarters in a row, setting aside the quarter the stores were shut for the pandemic. That is more than 6 years of unbroken growth in what it was actually selling. Read those together and the shop inverts. The piercing was not a service Claire's offered alongside the merchandise. The piercing was the reason anyone walked in, and the merchandise was what got collected on the way out. The earrings were the receipt. A piercing is one of the very few things in retail that cannot be shipped. A parent cannot do it at home. To buy it, a specific person has to be in a specific room. In the decade when every other mall tenant was hollowed out by a website, Claire's owned something a website could not take. Here is the proof the business itself still worked. It comes from the court file. On August 6, 2025, Claire's filed for bankruptcy in Delaware. A court order authorized it to begin closing stores, and the list attached to that order ran to 1,121 of them. The press reported around 700 closures. That figure came out on day one and never described what happened. The court's own paperwork does. I counted it, line by line, off the exhibits. 19 days after the filing, the revised lists landed. 1,121 had become 291, still closing. 830 stores had come off the list, not reopened, not saved by a good quarter, removed in a court filing, while the going out of business signs were still in the windows. The docket records the moment in between. On August 16th, the company discontinued the closing sales at certain of its locations. Nobody stops a liquidation halfway through 830 stores because the retail failed. Stores come off a closing list because a buyer is about to keep them open, so the mall traffic mattered. That part of the usual story is true. It is just not what put this company in court, twice in 7 years. On September 18th, 2025, the business was sold. And look at what the sale motion is actually called. A sale of going concern assets, free and clear of all liens, claims, encumbrances, and other interests. In plain words, sold as a working business rather than broken up for parts, and the buyer takes the assets while the old debts stay behind. That phrase is standard. It appears in essentially every bankruptcy sale, and I am not going to pretend it was invented here. But read what it describes. The stores, the brand, and the piercing service went to the buyer, Ames Watson, for a reported $140 million. $104 million in cash and a $36 million seller note, meaning part of the price is owed and not yet paid. The reported $691 million of debt did not go with them. It stayed behind with a liquidating trust, which is a shell left to pay out what it can and then close. The trust's own governing document explicitly excludes the assets the buyer took. The business and the debt were separated. Only one of them was worth money. So what is the lesson if you want to own a business? Debt does not care whether your business is good. It suits a business with boring, stable cash that does not need to keep spending on itself. It is dangerous for a business that has to keep spending to stay good. Claire's was the second kind. A piercing service is not a shelf of stock. It is trained people in maintained rooms, and that is the entire reason anyone walked in. The moat, the thing that kept competitors out, needed spending. And the spending had been committed elsewhere for 10 years. Seasonal revenue is a poor fit because the payment schedule does not flex while the takings do. So is a young business, which needs its cash to grow. So is one that leans on a single source of foot traffic, because the payment arrives when the traffic dips. A business with long contracts that rarely needs to re-equip can carry debt for years without harm. A strong business carrying too much debt can die. A modest one carrying none can survive a long time. Debt turns a margin of safety into a deadline. Claire's owned something no website could take. It still went to court twice, because a payment schedule does not care that your service is unique. So when you buy something, the first question is not what it earns. It is whether the debt comes with it. That is the obvious next question. What does a buyer get for a reported $104 million in cash, and why was $36 million of the price left as a note?